Sorry to come late, Abhishek. Did I just keep our video off for now, yeah? Or on?
Yeah, unless we are speaking, we'll be keeping the video off and keeping the mics mute. It seems like when any of the mic is on, it creates an echo. So great if everyone could, who's not speaking, keep the mics off. And the video is looking great, Amalie, great.
Great, thank you.
Yeah.
Amalie, it looks like this week we are in multiple events together.
And next week we'll see each other in person, I hope.
Exactly. Even better.
And have hopefully some time for dinner. And hi, hi Ethan, and hi Ravenel as well. It's good to see you.
Emily, good to
Curtis,
see you.
not Ravenel, sorry.
I go by, I answer to both.
Yeah, I know the feeling.
We've started the recording, folks, just FYI. And let's start in 30 more seconds. Great. So let's get started. Good morning, everyone. Very good morning to all of you from here in Washington, D.C. And thank you for joining us here today for the launch of a new study on market-based solutions to accelerate clean energy investments in emerging markets. That's a mouthful, but I can assure you it's equally rich in content. My name is Abhishek Bhaskar, and I work at the Climate Investment Funds, or CIF, housed within the World Bank. Among other things, I lead the Accelerating Coal Transition Investment Program, or ACT investment program, alongside the Technical Assistance Facility for Clean Energy Investments here at the CIF. I'll also be your host for today. We have an exciting lineup of speakers with us here today to share insights from the unique vantage points on this very interesting topic, which is increasingly gaining more importance and prominence in an era of growing deficits and increasing pressure on limited public finance that is available. The event will be spread across 3 segments. We have an opening section that will be kicked off with remarks from Thomas Anker Christensen, the climate ambassador for Denmark, which will be followed by a sneak peek into the key findings from the report. And then the second segment will include a panel discussion with folks representing key stakeholder groups talking about this topic from their respective vantage points. And finally, we'll have closing remarks by Mafalda Duat, who is the CEO of the Climate Investment Funds. Now, in terms of house rules, given this strong interest in the topic and in the interest of time that COP puts on all of us with the growing pressures on our calendars, we'll split the Q&A in 2 parts. We'll get to the first set of Q&A, which will be open to the public early on, right after the presentation of key findings. So please post your questions in the chat box that you see on the lower right corner of your screen. And during the rest of the event, we will ask our guests questions that were proposed in advance by some of you on this topic. And finally, do remember to tag us in social media in case you plan to tweet, Facebook, or LinkedIn. Our hashtag is hashtag CIF_action or CIF action, depending on the platform you use. With that, let us get started with a brief overview of who we are at the CIF and what is it that we offer before we open it up to our esteemed guests. So the climate investment funds we are one of the oldest and largest multilateral climate funds in the world. For over a decade, we have invested over 8 billion in clean energy, sustainable transport, resilience, and forestry activities, covering 70 plus low and middle income countries globally. We work exclusively with multilateral development banks, and while we are housed within the World Bank, that acts as our trustee, we also work with African Development Bank, Asian Development Bank, European Bank for Reconstruction and Development, or EBRD, Inter-American Development Bank, IFC, and which is part of the private sector arm of the World Bank Group. We have funded over 70 country-led investment plans through over 300 projects, and our $8 billion have mobilized over $60 billion in co-financing. Now, these co-financing come from a range of sources, from public and private, bilateral, multilateral, among others. All our projects contributed to one or more of the Sustainable Development Goals and have resulted in over 26 gigawatt in clean power, expanded energy access to millions of households, thousands of jobs, and enhanced capacity of people, among others. We offer large-scale, predictable risk capital in the form of concessional finance, which is financing that comes with extreme long tenors or low interest rates. We offer financing directly to real sector projects such as solar parks, geothermal plants, CSP, etc., as well as through financial intermediaries. So on one hand, we have an example of the landmark CSP plant called Noor in Morocco that most of you may have heard of. And on the other hand, you have examples of credit lines on rooftop solar in India, on energy efficiency in Turkey, and so forth, that talk about our role with regard to financial intermediation in scaling up climate action. So just to contextualize today's discussion, let me offer a quick example of an intermediation or a market-based instrument that we have used in the past to scale up climate action. In 2010, there was a lack of energy efficiency financing in Turkey. Although it had a robust financial sector and supportive policy framework, we introduced one of the first sustainable energy products on the market, working closely with EBRD. Now, EBRD leveraged financing from the CIF and the European Union to complement its own capital to set up a pioneering lending product and technical assistance for the financial sector. This triggered a market that has grown exponentially since then, a market that did not exist as up until that point. Now, since then, multiple iterations of the program were launched in the following years, and the third iteration did not even require concessional financing. And that is the success of using concessional resources in a targeted strategic manner to scale up market-based solutions. Now, there are other examples involving a financial intermediary around the world that have spurred climate action, and some of those are included in this study. Now, coming back to the study, through this work, we wanted to look closely at market-based instruments and explore how we can use them to accelerate clean energy investments in key markets. In particular, we focus on the role of financial intermediation, where we look at both the more upstream fundraising side, such as, say, issuance of green bonds, and more downstream, such as, or the funds deployment side, such as financing credit lines for on-lending activities, the Turkish example being one such case. Now, our premise for this work is that public finance is limited, especially in a post-pandemic world, with growing deficits on countries' balance sheets. Amidst such circumstances, the limited public finance must be used strategically in a way that alleviates risks, both real and perceived. It reduces the cost of financing and creates an enabling environment that can then mobilize the volumes of financing from the private sector that is needed to meet the 1.5 degrees ambition. So you'll find 4 case studies that will go into some of these models that have been used both in the developed and developing world, using both CIF and non-CIF resources to test out all of these approaches using some of the market-based tools that are out there. You'll also find 5 country-level roadmaps on Brazil, India, Indonesia, Morocco, and South Africa that explore opportunities for using market-based instruments to scale up climate action on the ground. Now, with that brief background and context setting, let me kick off proceedings and invite Thomas Christensen to offer opening remarks to kick us off today. Thomas, if you don't mind turning your camera on and coming in. And maybe colleagues, if you could remove the holding slide off the screen so we can all see the speakers. Thanks. Thomas, the floor is yours. I don't know if you're on mute. You might want to.
I was on mute. Sorry about that. Thank you very much, Abhishek. I've just moved office, so I'm still getting my equipment to work as I want to. But I'm sure everybody on this call knows the challenges of working from home and remotely. So thank you very much, Abhishek, for the introduction and for allowing me on behalf of Denmark to say come with a few introductory remarks. Friends, we are at the cusp of COP26 in Glasgow, probably the most important climate gathering for years, maybe since Paris. And this will be for a long time. It was labeled as the Ambition COP, but increasingly people are also talking about it as the Climate Emergency COP. But whatever label we attach to it, it's clear that it is seen as the best chance we have to keep the world on course for a 1.5 degree pathway, to keep 1.5 degrees within reach, as the incoming COP president, Alok Sharma, keeps saying. And in order to do that, it is clear that once we pivot towards implementation, once the ambition is commensurate with keeping 1.5 degrees within reach, and that is really politically the push that is happening as we speak, as we're moving to the G20 summit. But in parallel with this, we do need to focus on implementation and on the essential piece of financing, because accelerating energy transition related investments is absolutely necessary. The IEA estimates that annual clean energy investments need to move more than triple this decade in order to keep temperature increase below 1.5 degrees. And that means that the task is clear. Much more action is needed now. Every year missed is a missed opportunity. Securing a green recovery after the pandemic will allow governments to combine action to kickstart economies and increase climate action. So unlocking private green finance will be absolutely key to our chances for winning this climate emergency. Follow the money, as the saying goes. And I'm sure that this new report that we will talk about today from CIF and BNEF will provide an important contribution to the understanding of how financial intermediaries can be used much more widely and efficiently in the future to mobilize private capital. So just a few words on private capital mobilization. It indeed has the potential to become a game changer when public finance is limited. For many countries, particularly in the developing world, this is even more true now than it was before the pandemic, including with increasing public finance deficits and the enormous challenge to restart economies. So we have to do it smart and make sure that public money is spent in a way that allows to mobilize more financing for clean energy from private sources. In order to expand the knowledge in the financial sector of both the potential and characteristics of these investments, and to de-risk the investments so that they become more attractive for private investors, especially in emerging and developing countries, it is still a challenge to unlock investments. Investors tend to conclude that investments in these markets are more complex, more difficult, more risky, as Abhishek was also saying. So the development banks and the IFIs indeed have a very important role to play in this field, just like it is the case with financial instruments and funds blending public and private finance. And I'm sure that Ethan Sindler from BNF will take us through these options in a moment. But let me add that there is also an important role to play for governments. financial intermediaries and financial tools and access cannot do the job of de-risking and leveraging private finance alone. So policies remain a main driver for clean energy investments, and governments can indeed do a lot to prepare the ground and facilitate private investment by setting ambitious climate and energy targets and by ensuring long-term energy planning and transparent energy market regulation. If the right policies and regulations are not in place, it becomes more difficult to make good cost-competitive projects, and private investments in scale will not happen. This is where countries with longer experiences in clean energy may help with the creation of the right framework conditions. And Denmark, we are collaborating with 19 of the world's largest economies, most of them emerging economies, on energy planning. The objective is to share our best practices and contribute to paving the way for future clean energy investments at scale. And we need to tie that kind of planning in with the pipeline development and the financial services. So we are trying to highlight the importance of both energy and financial policies and regulation, as well as financial instruments and transaction enablers through some of the multilateral programs we support. So in closing, the CIF's Technical Assistance Facility for Clean Energy Investment is focusing on exactly these aspects. And that's why I want to thank you for the report, for the efforts you're undertaking, and also stress that in order to tackle the climate emergency and move into the implementation phase, what this report highlights and what it focuses on is really at the core of the issue when we move from ambition to implementation. So thank you so much and good luck with diving into the report. Thanks, Abhishek.
Thank you, Thomas, for making time to join us today and for taking us off. We are quite appreciative, as you know, of Denmark's support of clean energy agenda here at the CIF, and we look forward to our continued engagement on the topic. Thanks.
See you all in Glasgow.
See you there. We are excited to have Ethan Zindler, who is head of Americas for Bloomberg NEF, with us today. We partnered with Bloomberg NEF for this study, and Ethan will give us a sneak peek into key findings from our work. Before I hand over to Ethan, I also want to give a shout out to the rest of the team, some of whom he mentioned up top: Luisa, Dario, Sandra, some of whom have moved on since, and a number of analysts who have contributed to this work. So thank you very much. And before I gave Ethan the floor, let me give a brief introduction to his profile in case some of you, and I think there may be very few, who may not know as much. So Ethan manages Bloomberg NEF's analyst and commercial teams in New York, Washington, San Francisco, and Sao Paulo. He also oversees a team devoted to tracking low carbon policy developments impacting renewables, biofuels, and energy efficiency globally. And finally, he manages the production of Climate Scope, a project to profile clean energy investment conditions in emerging markets. Also, before I hand over, just remember to put your questions in the chat box during Ethan's intervention, and we'll get to those right after he's done. Ethan, the floor is yours.
Hi there. Just to confirm, Avi, can you hear me and see slides?
Yep, all good.
Excellent. Oh, good morning, everybody. And Avi, thanks for that really nice introduction. And thanks to the minister for those comments as well. I think that was a great table setter for this conversation. I actually can see many of the folks who are on this call. So I know a number of you have a high degree of sort of sophistication in these areas. But I also would just want to preface these remarks by saying that I never assume that everybody does. And so I do kind of want to break down these issues, in some cases, pretty basically for anybody who's unfamiliar with these questions or these issues around financing renewables in developing countries and in that context. Before I go on, first, I do, of course, want to thank our friends at the Climate Investment Funds for the support for this project. This is actually the second time we've worked on a project together. The first we presented a couple of years ago in Morocco outside that rather spectacular Ouazzazate Noor solar project right after it had begun operations. And we're really pleased to be able to work again. And really this project benefited enormously from their input and their understanding of the issues that are going on in this sector. I also, of course, want to make sure I do thank my colleague Louisa de Moro, Antoine Wagner-Jones, and Sandra Esser, among others, who really did the hard work to put this project together. Okay, so I'm going to start off by just pointing out that, we are now, literally hours away from the start, maybe 4 days away from the start of the COP26 conference, as the minister mentioned. And I think that the topic that I'm going to talk about today and that the rest of the panel will talk about is particularly timely in that context. To refresh everyone's memory, in the Paris Agreement in 2015, among many things, there was a promise that wealthier countries were going to be able to provide $100 billion per year to less developed countries to develop and address climate change, to develop projects and through mitigation and adaptation in the face of climate change. So very helpfully for this particular report, after we've been working on it for a year and a half, on Monday, there was a report released by the organizers of COP, the UK government, in conjunction with the German and the Canadian government, in which they looked at this question of the $100 billion. And what they said was basically this: while the outlook towards 2025 demonstrates continued annual increase in climate finance and that developed countries will collectively meet the $100 billion goal, developed countries recognize that reaching this goal is delayed. I'm not a politician, I'm not a diplomat, but that is a very passive way of basically saying, hey, we whiffed, we did not make the number. And by their own calculation, which is using OECD figures, you can see that the goal was for 2020 was 100 billion. They don't have a final number. We don't have a final number either for how much went in, but I think we can say with a high degree of certainty that the number did not rise from 80 billion roughly in 2019 to 100 billion. So that number effectively, that box was not checked. And not surprisingly, that will be a major point of discussion at COP in just several days, in part because a lot of the pledges that developing countries have made has been contingent on this part of the promise from wealthier countries being fulfilled, and it has not. I did want to offer a little bit of context, though. So, basically, you just saw about a $20 billion gap to goal. I'm going to, at the risk of sort of overloading you with numbers, I did want to give a little more context, though, about sort of where we see the market overall, and to give you a sense as to how big a challenge this is or is not overall in terms of trying to scale up clean energy deployment and development in developing countries. This is just a look at our annual tracking of what we call energy transition investment. And this is a category that includes renewables for the most part. It's about 2/3 of the total, but also electric vehicles, hydrogen, energy storage, a few other things. But it's a pretty narrow category. We're not including things like gas. We don't even include nuclear in here. And you can see that last year we tracked about $500 billion that went into this sector overall globally. And about 60% of that went into high income countries, not too surprisingly, the wealthy countries. And then about 160 billion, though, went into upper middle income countries. These are World Bank designations. And I would note that actually the vast majority of that came domestically. So for instance, China basically, for the most part, finances all of its own projects. Brazil, through BNDES, finances most of its own projects. This is not a cross-border flow number, but I guess my point is 500 billion is a lot more than 20 billion. And, in the grand scheme of things, that's not a whole lot of money. The $20 billion number looks even smaller if you think about it in a slightly different context. We also track the total amount of money that goes into what we call sustainable finance. So these are things like green bonds, social bonds, sustainability-linked bonds, green loans, sustainability-linked bonds, whole bunch of different flavors of different types of money that's being raised primarily through institutional funds. And you can see that, this number has consistently been rising. We've tracked over $3 trillion that's been invested in this area to date. And that I really would focus on that very last bar. And you'll note that that's just the first half of 2021. That's not even and that's not an annualized estimate. That's just the first 6 months of this year. we were tracking at $825 billion in new capital that came in. I don't have an annualized estimate, but it's certainly going to chop $1 trillion this year. So again, within the context of that $20 billion gap, that just seems like an incredibly small amount of money compared to the amount of capital that is sort of raising its hand and saying that it wants to be involved in addressing the climate challenge in some kind of way. One last thing before I get into the findings of the report, just to continue to sort of contextualize this. Meanwhile, one thing that we as a firm do is track the levelized cost of energy in different countries around the world. And at this point, we're at the point where over 2/3 of the world lives in a country where wind or solar is the lowest cost option for adding the next megawatt of capacity. Just to repeat that, renewables are the lowest cost, most affordable option for adding a new megawatt of capacity in these countries that you see on the map. But I would also say that for some of the ones that you see in light gray, that's frankly, we simply haven't had a chance to do the analysis or don't have sufficient data to do it. But in particularly a number of countries across sub-Saharan Africa where there is good solar resource, there's no doubt in my mind that solar is also the lowest cost option there as well. So the point is renewables make sense financially. They should be growing in these countries. Okay, so just to recap, again, $20 billion gap that's being talked about this weekend and into next week at COP. On the other hand, pick your number, either $500 billion a year going into energy transition investment or sustainable investment of $1 trillion or so. But basically, there is an enormous amount of capital available. And meanwhile, renewables are cost competitive really across the board. And that brings me to to discussing today's report, which again, very appreciative of the climate investment funds and working with them on this project together. So first, the report itself is about a 90-page report, and I would encourage folks to download it if they can. We will, I think, give you the URL by the end of the session. But it also includes 5 different roadmaps, as Abhishek was mentioning, for 5 key countries that we looked at. There's so much in this report. I'm not going to try to go through really every aspect of it here. I'm really going to give one illustrative example. And then really encourage folks to go check this out themselves. I'll talk a little bit now, though, about what some of the risks are, but also some of the opportunities that we see as well. Okay, but first, before I go much further, I want to talk for a second about sort of the framing of the report, which is what are financial intermediaries? And I know there's a number of folks on this call who probably know this term pretty well. But I've been working, I must confess, for 15 years in this space, and financial intermediaries was a new term to me when we first started doing this project. So for anyone who doesn't know what it means, here's just a quick explainer. Financial intermediaries are really quite simply the entities that sit between major pools of capital and the organizations or people that need the money to build like a wind farm, a solar array, or a battery. Pretty simple, right? So basically, you get money from capital providers. They go into the financial intermediaries. The financial intermediaries are responsible for paying back those capital providers in the form of some form of interest or dividend or return on investment otherwise. And then at the end of the line, there are the borrowers, or those who are actually doing projects or installing systems on the roof. If you're talking about consumers, they in turn take this capital and put it to work in some meaningful kind of way. So the financial intermediaries can mean a lot of different types of things. And so just to give you a sense of that, they could be anything from venture capital funds, investment banks, pension funds, banks and capital markets all can play this role. I just skipped quickly over the left-hand column, which is just where the money starts, which can be public shareholders, it can be limited partners and others. Then the borrowers that we looked at can be anybody from startup project developers to IPPs, development finance institutions, and coal plant owners. And then the instruments that are used, you can see there as well. So these are really, it's a very broad scope that we looked at in the report. And actually, you'll note that not every example we gave is necessarily in the developing country context. We have some that are in wealthier countries as well. But basically, it's how you you find clever ways to put private capital work to develop clean energy globally. For the sake of this conversation today and most of the report, we focus on developing countries. All right, so what are the risks that investors face when thinking about developing countries? What is it that might be, frankly, the hangup over deploying that, whether it's $20 billion or more into countries that pose a risk? That are in emerging markets. First, obviously, there is country and political risk, and this is really the question of overall stability that a country might have in terms of a regime change or something else that might imperil the development of a project. The second is currency risk, which is the value of whatever the local currency is, and the chance that it could potentially devalue from a project developer's perspective. If you're going to buy equipment and it's coming from overseas, if the local currency devalues, then you have less buying power. If you sign a power purchase agreement in which you agree to sell your power at a certain price, and basically it's going to get paid in local currency, but you have outstanding debt that's in dollars. If the currency changes, then you can get stuck. These are the types of challenges that are often faced. There's policy and regulatory risk. This is kind of like a less dramatic version in some ways of the first one, of country and political risk, which is, a policy is tweaked after a project is under development, or there's poor enforcement of existing contractual laws, or the price of power changes, the rules for powers changes, something like that. These are, again, it's not that a government is toppled, but it's more that you actually see a change in the rules of the road. Then there's, of course, execution and operational risk in projects that can be delayed by land disputes, local objections, challenges with grid connections, and other kinds of issues. And then sometimes projects just don't really perform as well as people would hope. And then finally, there's this question around technology risk and this concern that new techs could underperform or really fail entirely. And this is an area that I think we've seen an enormous amount of progress and development really over the last 10 years. Originally, wind and solar were regarded as risky technologies. They were ones that investors or lenders wanted a premium in terms of return on because of the supposed risks that they posed. But really, the comfort level now for a conventional wind and solar project is really pretty high. On the other hand, batteries are really kind of in the middle area. We are seeing growing comfort from investors around the technology. But they're certainly more hesitant in the developing country context to support those. But nonetheless, to some degree, you can kind of cross off technology risk when you're talking about standard wind and solar projects. And that's great news for the world. And another reason why we really should not see much more hesitation in terms of the deployment of capital to support a scale up of renewables. Okay, so I'm going to talk really only about one example, and there are quite a few in the report. And this one certainly involves our friends at CIF, but I would point out that there's a number of others in the report that don't actually have development finance involved at all, purely private capital stories. But this is the one, in the interest of time, I wanted to share and certainly encourage folks to take a look at. It focuses on the Honduras Renewable Energy Finance Facility, which was an example of multiple parties coming together to make capital available to small-scale players that were looking to develop clean energy in really what is one of the poorest countries, at least in the Western Hemisphere. About 80% of the country, just by example, has access to electricity in Honduras, which is one of the lower electrification rates in the Western Hemisphere. In terms of the grid, just as a snapshot, this is where we stood in Honduras in 2016. A small country, as you can tell, in terms of total gigawatt hours of consumption, but about half of the generation was coming from oil and diesel, about a third, let's say maybe 40% from renewables, and then a little bit at the top that you can see that was coming from coal. So HREF, as you can shorten it to, is the first clean energy investment fund established in Honduras, and it's structured like a VC fund or venture capital fund. It's managed by a general partner with shareholders that act as limited partners, and the general partner manages the fund for a fee from limited partners and receives 20% of any excess return that's generated. In the case of HREF, the management company is a consortium between the Sustainable Energy for Central America in Costa Rica and the Canadian impact investing firm Deakin Impact Sustainable Energy. The targeted preferred annual rate of return is 11% over the lifetime of the fund. For HREF, the IDB, the Inter-American Development Bank Lab, and the CIF's own Scaling Up Renewable Energies in Low-Income Countries program, sorry guys, that's a mouthful, but otherwise known as SREP, acted as the initial limited partners and capitalized the fund with $4 million and $20 million, respectively. To kickstart the capital commitments from further entities, a quarter of the SREP resources, or about $5 million, was structured as first loss capital. Employing SREP funds in this manner had the aim of improving the risk perceptions for other entities, and it helped to bring in private capital as well. The $24 million initially from SREP and IDB Lab managed to secure another $34 million in co-financing, including some resources from the private sector. The funding was initially aimed at about an 18-to-1 leverage effect for local commercial debt, that is to bring in money that would come in alongside this, with the target of $44 million seeking to allow small-scale project developers to access $346 million of local commercial debt. Overall, the fund aimed to add about 150 megawatts of renewable capacity by project close. In terms of the funds, in terms of how the funds are actually at the end of the day intended to be used, it aims to support financing at near market rates to on and off-grid small-scale clean energy and efficiency projects. And this includes things like mezzanine financings, and eligible technologies are biomass, biogas, small hydro, small-scale solar PV, of course, waste energy and wind projects. In addition, smaller scale projects such as focusing on rooftop PV or solar water heaters could also apply. So this is where we are today in terms of Honduras. A sharp decline in oil and diesel consumption, as you saw, for several years into 2018. I don't know what the 2020 number looks like, to be honest. We don't have a final yet on that, but you can see that basically we have seen a real growth in renewables. And to be clear, we can't attribute all of this to the HREF program, but I think certainly we have seen a healthy improvement in conditions there. And if we look at the split between private capital and public finance, in the years up to the HREF program, you can see things kind of, vacillated, but basically with public finance above, and then private finance really got more involved from 2016 on. The caveat, of course, here with a country like Honduras, a tiny country, is that the numbers can spike up and down year to year. That's sort of inevitable. But if you look at the actual amount of targeted new capacity through HREF versus what remains, you can see that there's a good way to go, and the program does last to 2029. But there's no question that there's been very good progress so far in this area. So I'm going to try and finish up here because I know I'm covering a lot of ground. But before I did want to talk for just a second about the roadmaps that I would really encourage folks to take a look at. Because like I said, in addition to the roughly 90-page report that our team prepared in partnership with the CIF, we also did these roadmaps, each of which is about 40 slides long, and I think provides some very useful insights on the state of play of renewables in each of these markets, but then also offers some useful thoughts about current challenges and how to potentially overcome them. There's way too much for me to try and explain all that right here on one slide, but just at the highest level. First of all, we looked at the power market fundamentals and the financial sector fundamentals of each market. And these green and yellow lights here are entirely qualitative, but the point basically being that there are certain conditions that are better than others in certain countries for either development of projects in terms of how well the power market is structured, and then the second in terms of how mature the financial market is to attract capital. So quite quickly, for India, what we've seen is the Modi government has made enormous promises around renewables, a great deal of ways to go towards those. And the primary challenge there is that coal does remain often a real cost competitor. And getting around that, I think, is going to be one of the great challenges going forward. But no question about it, we've seen real flows of private capital coming in, including one of the examples that's in the report of another developer called Renewable. In South Africa, again, challenge from local coal and the cost there, but also really the current condition of the existing state utility, Eskom, I think poses a real challenge to development. Indonesia is an interesting one in the sense that it's at least one of the somewhat unusual countries where there's actually enormous a number of parts of the country where there's actually overcapacity available and a good deal of additional coal-fired power plants still in the pipeline at this point. And so addressing that, I think, is certainly one of the challenges. Morocco, where we were several years ago at the Noor plant, needs to, we think, revive utility scale clean power after a procurement lull as power demand grows. And then Brazil is really the one country where we didn't look at the power sector, but we looked at transportation. And the reason for that is that it's not that that you can check the box entirely on Brazil and the power sector, but rather that that in the power sector that they already get the large majority of their electricity from zero carbon sources in the form of large hydro. So we took the opportunity there to look a little bit more at transportation, and it's a really interesting transport market because it's really the U.S. has some consumption of ethanol, but Brazil is really the only major market where ethanol serves as a fundamental alternative fuel already for drivers of cars. And so the question is there a room for a third fuel, which would be electrified transportation, given that it really has to compete against not just one incumbent fuel, but two. So we offer some thoughts on how you might jumpstart that. All right, gang, so this is the last slide, and then I'll hand it back to Abhi and look forward to maybe a couple questions. So this is a nice framing that my colleagues put together to sort of think about some of the key takeaways. But like I said, there's a lot in the report, and I encourage everyone to check it out themselves. I won't attempt to try and summarize everything here. But the first is, for commercial investment and development banks and green banks, we think that there's a real important role to jumpstart the markets where private capital just won't go and back the riskier technologies. You saw back on my earlier charts, we looked at upper middle income countries. If you look at the least developed countries, out of that 500 billion or so that we've seen globally, generally less than $1 billion per year goes into those countries. And this is the place where obviously there's a role for these investors willing to take higher levels of risk. Second is really important is to be innovative and to be open to new structures, technologies, and business models. And I would emphasize this in the context of the clean energy evolution or revolution or whatever you want to call it. A lot of it is very organic and is coming from the bottom up, and a lot of it involves some very small players. These are not always the traditional models that I think DFIs are set up to deal with, although I know there's been a lot of progress in that effort in that regard over the years. The third thing, and really important, I would say, is offer technical assistance to enhance enabling environments. If I showed you, to a fully private sector audience, some of the numbers I showed earlier, I think they would say, look, we want to invest money in developing countries, but we can't find projects that are acceptable. And to some large degree, I get that because they have certain criteria that they need to meet in terms of investment. And the best way to make sure that projects can meet that criteria is to improve the local technical conditions, the enabling frameworks, the policy frameworks, so that they feel comfortable developing locally. And so this is really where the expertise of those folks, in that first box, can play a role in helping governments to set the stage to welcome private capital. And then, of course, there's the important thing is to have the discipline to just get out. Once private capital is ready to come in, there's really not much of a reason for some of these players in the first box to be involved, particularly middle-income countries that are developing standard wind or solar projects. Often in Latin America, these can get financed purely with private capital. And so there's not always a real need necessarily for green banks or DFIs to be quite as involved there. Now, as we think of those sort of giant pools of capital, the insurance companies, sovereign wealth funds, pension funds, here's just a couple ideas. Well, one is to support structures that aggregate and capitalize assets to make them more tradable. So taking existing projects that are out there, that are developed, that are functioning, and making them so that they can be securitized in some way, so that some of those giant funds, whether there's whatever kind of sustainability fund that's been raised institutionally, can come in, take those projects out, put them into a portfolio that operates, and then the local developer can go on about their business of developing more projects. The other thing is increasing liquidity by tapping a larger range of instruments and intermediaries, and we think this applies to the final category on the right-hand side as well. And then this is pretty consistent with those folks on the left-hand side, which is to adapt an open-minded approach to supporting new technologies and asset classes. This world of clean energy finance is extremely interesting and exciting, in part because it is moving so quickly, but it does require investors to really think in new ways, in some cases, about taking chances on new types of structures and new types of projects. And then finally, for private equity, venture capital, and credit unions, we suggest finding ways to connect institutional pools of capital with projects, which is basically to try and unify that second column with the third, and eventually with those who are developing projects at the end. So with that, I'll just stop and say thanks so much, Abhi, again, and to Mafalda for the support on this project. And I'm happy to take any questions if we have time, or later just to be involved in the discussion.
Thank you so much, Ethan. Very rich content, like you said, and like we knew is hosted within the report. This is a very relevant topic, and not just because of COP26. Countries are having to prioritize how they spend their precious public finance, and hopefully what we have put forward will offer insights to our key stakeholders into potential ways to mobilize additional capital in pursuit of their sustainability or climate goals. So like you said, we'll come back to questions perhaps later in the segment in the interest of time, but thank you once again for making yourself available. For this next segment, we have a number of colleagues representing a range of stakeholder groups, from multilateral development banks to development finance institutions, and to those who are involved in the area of private sector finance. They'll be sharing their thoughts on the topic based on their unique vantage points. And the first, I would like to call upon Amali Amin, who is representing the CDC Group here today. CDC Group is the world's first impact investor with over 70 years of experience of successfully supporting sustainable long-term growth of businesses in Africa and South Asia. It is the development finance institution of the United Kingdom, focusing on some of the biggest global development challenges by investing patient, flexible capital to support private sector growth and innovation. The company has investments in over 1,200 businesses in emerging economies, with total net assets of 6.5 billion British pounds and a portfolio close to 5 billion or so in British pounds. Amali is the Director of Climate Change at the CDC Group, and she'll talk about some of the CDC's work in the area. So Amali, CDC has been doing some very interesting work in India, if we can bring India into this conversation. There is Ayana, the utility-scale renewable energy platform that has a target of over 6 gigawatt of operating assets. It's also involved in a number of, on the softer side of things, in terms of TCFD training for banks, being part of the governance structures to really guide and shape their strategic approaches. Can I ask you, how has CDC been looking at market-based solutions, both on the fundraising and the fund deployment side, to meet its climate objectives? Amali, over to you.
Thank you very much, Abhishek, and it's always a pleasure to rejoin the CIF family at these events. So thank you very much for the invitation, and also great to hear Ethan give the latest insights from Bloomberg New Energy Finance. So really welcome and thanks. So maybe just before I'll talk about our approach, or one of our approaches towards intermediation, financial intermediation, in a minute. But I also just wanted to flag, in particular, some of the work that CIF's now looking at, and an area that we've been looking at in CDC with India, the Indian National Institute for Finance and Policy, as well as also in South Africa, the Trade and Industrial Policy Center, around the just transition, because I think, you know, we know now that if the world and collectively and countries individually are to really deliver on the Paris Agreement and to stay, you know, with 1.5 degree centigrade temperature increase, that this requires really quite profound transformation of their economies, and in particular it will require a phase out of fossil fuels over time, particularly coal. And so it's essential that we look at how we can ensure, as we invest, that we are doing so in a way that doesn't leave stranded workers and communities, as well as stranded assets, which of course is a key part of the Task Force on Climate Related Disclosure, which Curtis on this panel is instrumental within. And I just wanted to flag that our work in India over the last year or so, we've been looking at how, through our investments and as we engage with our investees, how we can ensure that these issues around a just transition are brought into our strategies. So I'd just like to commend and congratulate really the CIFs for all the great work that you've been doing on the climate, on the just transition, and that will be particularly important in the very, very exciting new Accelerating Coal Transition Programme in particular that was recently announced under the CIFs. In terms of financial intermediation, so we do this in differing ways. One approach that we take at CDC that is something we've been working on in different contexts is where we actually create platforms. So these are normally sort of dedicated platforms that can basically crowd in different sources of equity. This is something we have done. You mentioned the IANA platform that we were established in India to invest in utility scale renewable energy. And that is also actually one of the investments where we've been really, alongside the equity investment, we've also been providing training, working with local organizations to actually provide training and skilling, particularly for women in the renewable sector, which is also, of course, then part of this just transition agenda. I'd like to maybe talk about one fund that we invested $70 million in very recently that closed recently, the Green Growth Equity Fund. And this is actually, I think, particularly innovative because it's almost a platform of platforms. So we have worked with other partners, the fund manager, Eversource Capital, which is a joint venture between Everstone, a leading India private investment group, and Lightsource BP. And we created this platform to actually look at a way of scaling and promoting and enabling synergies between different investments. So within this single platform, the portfolio already includes a number of key investments. And in fact, actually, IANA now is one of the assets that this platform has acquired. Other examples are Radiance, which is a provider of renewable energy solutions to the commercial and industrial sector. Green Cell Mobility, which is an e-mobility platform, so investing in electric vehicles and relevant infrastructure. Also looking at sort of more sustainable waste management and water management. So this kind of intermediation we see very much addresses all the points I think that Ethan was referencing, that we can help to deliver synergies across particularly these very early, very nascent sectors, which may not be so attractive to private capital. We can also ensure more common standards so that investors have much greater certainty and clarity over the types of investments within the platform. And then, of course, we can deliver scale. So this is just one example of how we, as CDC, this is quite a common approach to the way in which we invest, where we would work with partners around these types of platforms to crowd in all the different sources of equity investment. Abhishek, do you want me to carry on, or?
Yeah, please. Any final thoughts? Yeah, please go ahead. I know you have to leave, so I don't want to push you, but please go ahead. Yes,
no, and unfortunately I do need to leave on the hour, so apologies for that. But yes, so I think that's as I say, this is very much core to what we've been doing in India, and when we think about these sort of more innovative, particularly the small scale, quite innovative technologies and businesses that are coming forward, we know that financial intermediation is essential. And so these types of platforms are ways in which we can help channel the different resources that we have, bring in other investors in a way that helps build confidence of the market, because they can see, even though these are quite small companies, they can actually see certain scale, and there is much greater understanding of what these assets really are, as I mentioned, through the sort of more common approach towards standards around these. So, really trying to address this key challenge of how to really mobilize capital at scale, recognizing that that is particularly challenging for more early stage, more innovative, for those technologies and solutions that, of course, inherently have more risk. So these platforms are not just a way of trying to channel the finance, but very importantly, to actually overcome some of the risks that many of these types of climate technologies, services, and other types of businesses are facing in attracting equity investment in particular. So and as a impact investor, responsible investor as well, we would also work closely with the investees to provide additional resources, which could be expertise, helping build providing training and supporting the development of capacity, as I mentioned with Ayana, where we provided training to particularly women in the renewable sector. So also enabling the more transformational type of investments that are going to be needed over time by building out the skill set, creating building out the sort of local economy, if you like, so that these types of investments become more and more part of the norm.
Thank you very much, Amali. I think this is a really interesting approach, as we had discussed before, to mobilizing action and investments, especially on thematic and strategic priorities. And the GGEF has received a lot of interest and curiosity about how and where it ends up. So we'll be curious to see the kinds of lessons this throws up as we move along, and things that we can all learn from. So thank you once again for sharing that, and thank you for making time to join us today.
Thank you very much. Bye-bye.
Moving forward, the World Bank Group has not just been deploying development finance on the ground, but it has also been a leader in the issuance of green and other thematic bonds in pursuit of sustainable development goals. World Bank also offers a number of services to client countries to strengthen the capacity and potential to attract investors. We have James Seward here with us today, who works at the World Bank Treasury. And we also have Heike Reichelt, who is the head of investor relations for the bank, to talk about some of these offerings. So let's start with James. James, how does the World Bank help countries attract investors so they can use public finance effectively while pursuing their sustainability goals? Over to you.
All right, thank you very much, and glad to be here. And I would also echo the calls. Please go out, download the report, read the report. It was a really great report, lots of insights, and I really actually enjoyed reading it too. It was very crisply prepared. So another plug for the report, and congratulations to the team. And yeah, I think we're all pulling in the same direction. That's the basic message that we feel here. I think one message that we also get through is in terms of the scale. The scale is really huge for the types of investments needed at this point. And the way we look at it as a capital markets player ourselves and intermediary ourselves is that the capital markets really are a key part of the solution for the climate financing agenda. And what we've seen, and Heike can talk more about it in terms of our evolution of funding from green bonds onto sustainable bonds, is our clients and investors are also looking for the same types of instruments and the same type of investing approach. What we've sort of come to conclude, particularly talking to investors, is one key feature that might be a bit underrated in discussing how the funding can be raised in the capital markets is the transparency of, for instance, sustainable bonds or green bonds or social bonds that are issued. And what we typically see is that investors are interested in this in particular because they can see now some trace to the kinds of spending that the governments are actually taking on. And I should note that, the bank, our role is really to engage with the public sector, so the sovereigns of countries. And from a treasury perspective, we kind of function a bit like a sort of investment bank type to the public sector. So that's sort of our focus. But investors are looking, and of course, there's all the credit dynamics and risks and so forth that they look at. But the having this lens into the sustainability spending and different kinds of activities that the governments are doing actually helps give them a level of comfort. And from our perspective, some of the advisory work we've been doing, we engage with our clients to help build up the frameworks, help build up the transparency, help build up the taxonomies, for example, for eligible green projects. And in doing so, it also gives a layer of comfort both to the issuer, but also to the investor, that this is actually all done in international best practice and in ways that really can be counted on. That if a government says, we're spending X amount of money in the green space, for example, for clean energy, that in fact that's true. And that involves things like second-party opinion providers, it involves external reviews, it involves monitoring, impact reporting, all things we help our clients with. So that's one sort of feature of our advisory work. And what I would say there is that the kind of work we've done, we're starting to see some results. I think collectively we can all see in the markets that not enough has been done, not enough issuance has come out. There's a lot of talk, but not a lot of action in terms of new sustainable bonds coming out, new green bonds coming out, for example. But the trend is clear, the investor interest is clear, and we're seeing some interesting cases. So I'll just maybe highlight one case on the advisory side that's useful, and maybe later we can talk about some other cases that combine financing and advisory. But Egypt is one case I would just highlight amongst many that we've worked in. The Egyptian government decided they have a very ambitious climate plan, and particularly to move renewable energy investment from around 20%, at least that I have in my notes here, to closer to 40 to 50%. And so in doing so, they were looking at, well, how can we actually finance this in a way that we can tap international capital markets to meet some of these needs? And we got involved with them early on. One key thing is to help them also engage with others who've gone to the markets this way and gone with, for instance, green bonds. So the government decided, well, this looks like an interesting approach. They decided we'll go with the green bond. It took quite a bit of time, quite a bit of effort internally within the government to come to this conclusion and develop the framework, develop the policy, develop the vision for what they were going to do, and then arrange the financing directly after that. Now, the question here is, what's the impact of this? Well, they decided first we're going to go with 500 million for a bond issue. This was around September last year, and it was the investor interest was 7 times greater than that. So they upsized the issue first of all. Then when they went out, the issuance went out 50 basis points under the initial pricing guidance, which was really a very positive impact. And finally, they crowded in investors that they hadn't had before. 16 new investors came to this issue that had never invested in Egypt before. So that was another goal of the government, to go out this direction. So that was a very positive effect. And now, because of the success, they're looking at going out to the markets with a program of green bond issuances going forward. And this really, I think, is just one small case amongst many, but I think we'd want to see a lot more of these kinds of cases coming through, both from sovereign, but also some sub-sovereigns and others to come out to the international markets with these kinds of issues. So maybe I'll stop there. I'm happy to talk about another case we've had in Indonesia and highlight the case we've worked on there. But I know time is tight, and I see some people are dropping off, so let me stop there.
Thank you, James, for sharing some of those advisory offerings. It highlights the importance that this upstream support has and the difference that it can make to help mobilize and scale up investments in client countries. Moving from the advisory side to on the fundraising side, let me next invite Heike Reichelt, who is the head of investor relations at the World Bank Treasury, to talk about the fundraising side of things. Heike, can you share further details about this recently launched initiative? I think it was 2 weeks or 10 days ago, that highlights climate through investors' engagement around the sustainable development bonds. How did it come about, and what do you aim to achieve through this most recent initiative? Thanks.
Sure, thanks, and thanks very much for inviting us. It's been very interesting listening to all the panelists. So that initiative is something that we launched a few weeks ago, and it's really a way to engage investors around the topic of climate and integrating climate into all activities. So Tom was mentioning the climate emergency, and that's really the starting point for our discussions with investors. We're highlighting how important it is to integrate climate into all activities or investment decisions, looking for opportunities to support mitigation, but also focusing on adaptation and resilience investments. And this engagement with investors as part of the initiative has given us the opportunity to talk about the World Bank's Climate Change Action Plan that was recently announced. So I have to say that Ethan was saying he doesn't assume that everybody knows everything. So let me just say a couple things about who investors are when we talk about investors. So the World Bank, or IBRD, issues about $50 billion in the capital markets every year. And our investors who buy the bonds are private sector investors, such as pension funds, asset managers, some retail, but mostly large institutional investors, as well as some public sector investors. And they buy the bonds because of their AAA credit rating, the liquidity that they need, and the currency or financial structure. So that's the primary reason they're buying our bonds. And for most of the historical evolution, I would say, that was the reason they bought our bonds. But more recently, and it's really been catalyzed by the first green bond that the World Bank issued in 2008, investors are very aware of climate risks and looking for climate opportunities, and are very focused on purpose, sort of what are the funds being used for. So the conversations that we're having with investors have completely changed. And there's a lot of focus around transparency and reporting, and this was also brought up by Jamie. And in 2015, the World Bank worked with other IFIs to start the first harmonized framework for impact reporting for green bonds. And this has been, this has evolved. Many people may have heard about the green bond principles that are published by the International Capital Markets Association. They're modeled on the first green bond that the World Bank issued, and that has been expanded to social bond principles and to sustainable bond guidelines that cover social and green. And the guidelines and the principles are all focused on helping financial market participants understand the frameworks that issuers are expected to publish, and also encourage reporting and second opinions for accountability. And Amal Lee spoke about the profound transformation, and this is something that our initiative is also focused on, talking about how the World Bank works with client countries, not just looking at sectors that one would expect climate investments to be in, but we talk about how 95% of all IBRD projects have climate co-benefits. And if you take this back to labels and green bonds, labels help focus investors on the purpose, but we're highlighting through the initiative and talking about our sustainable development bonds, we're highlighting the entire balance sheet of the World Bank. And we're also talking to investors about how it's important to focus on all of their investments. So not just a small portion of the bond markets, which yes, it's growing and it's growing very fast, but it's still about 3% of all outstanding bonds. So these conversations that we've been having with investors have been very interesting. All investors are focused on this. They're all looking at environmental, social, and governance criteria in their investment decisions. Of course, they are still focused on financial aspects, so the credit risk, all the financial terms, that has to all fit with their portfolios. But they're very interested in how funds are being used and trying to understand risks as well as opportunities. So let me stop there. Abhishek, back to you.
Thank you very much, Nikki. Thank you for making time and for these really interesting insights. I think these are some really important measures towards further mainstreaming of climate action at the World Bank. It not only sets up a healthy precedent, but also a lot of lessons for others to learn from. So thank you once again for making the time, to both you and Jamie. Thanks.
Thank you.
Moving on, our final speaker, let me invite Curtis Ravenel, who is Senior Advisor to UN Special Envoy on Private Sector Climate Finance and former Bank of England Governor Mark Carney. Curtis, we are headed to the COP, and you have been engaged in multiple conversations on the topic of funding net zero transition using private finance. Can you share with us where the current thinking is on bridging this demand and supply side of private sector financing? Some of this Ethan alluded to in his opening remarks as well. But what insights can you share based on what you are seeing from where you're seated? Over to you.
Well, thank you so much. And thank you for having me. I think the report is so timely and so important. Let's just take a little bit of a step back and acknowledge that really the price of meeting net zero ambition is estimated, this is between now and 2050, is estimated between 100 and 150 trillion over the next 3 decades, right? And about 2/3 of that will need to go to emerging and developing countries. And so really, if you break down the math a tiny bit further, you're talking about by mid-decade, we need to be financing about $1 trillion a year in these economies. That is a lot of money. And what we've tried to do within the COP26 Private Finance Hub is identify, where is that capital going to come from? Well, one of Mark's initiatives, it was something that he created called the Glasgow Financial Alliance for Net Zero. And this is basically a constellation of financial industry specific net zero organizations. So the Net Zero Banking Alliance, Net Zero Insurance Alliance, and so on. That aggregate amount of capital that has basically, and in order to qualify to sign up for this, you basically have to commit to a transition plan. You have to commit to measure progress against a low or no overshoot 1.5 or below scenario. And you have to report on progress every year. So this is a real institutional level commitment. It doesn't mean I'm going to do more green financing only. It's a little bit what the earlier speakers were talking about, is these institutions are basically mandating that they themselves will align their entire business with a net zero approach. So when it's said and done at COP, we expect the total number of assets in these alliances to be in excess of $100 trillion. So acknowledging that we need 100 to 150 trillion, and probably 1/3 can be financed by the companies themselves. They don't always need external financing. They have their own cash flows. The money is there. So now the question is, how do we get the money to the right places? And everything that you all have been speaking about today are all the various ways in which you can do that. It is interesting if those financial institutions are committing that all their business will be sort of net zero aligned over time. We do have a disconnect, though, as Ethan alluded to earlier, in the sense that you've got all the growth in the emerging and developing countries, and I think the estimates range from, like, on average 3 to 5% GDP growth a year in these countries versus the 1 to 2% in the developed world. Yet the capital flows is the reverse. You got way more capital flow in the developed world than you do in the developing world. And how do we fix that imbalance? One of the things that Mark has been discussing with finance ministers, central bankers, and yourselves, all of your bosses, I think, have had a visit with Mark at one point or another, is creating, really leveraging this whole idea of country platforms, which have also been discussed. And of course, the World Bank, advocated for country-led and country-owned platforms model since 2017, and the G20 finance ministers endorsed a reference framework for effective country platforms in 2020. I think what we'd like to see is this: you have this chicken and egg scenario where you say the financial institutions are like, the money's here, but we need enabling environments and we need all these other risks that Ethan pointed out to address. Meanwhile, these countries and developing countries are all saying, hey, we need the capital in order to make it work. So we need to bring that together. I think Mark's vision is that if you have adequate and sufficient and ambitious NDCs, that we could create a sort of top country platform that could help deliver this. And I like the example jurisdictions that were alluded to earlier. There's real opportunity here. I think we'll all acknowledge that this is, my father used to have a phrase saying, the greatest force in the world is inertia. This is hard work, but collectively, it feels to me like what we're trying to show at COP is that the financial community, the private financial community is making the commitments. And now we need to all work together to try and execute and deliver that capital. And that's going to be some hard work. But as we all know, this is a journey. This is not, it doesn't all end in Glasgow, right? It's really just the start of mobilizing that capital. I'll stop there for now.
Thank you, Curtis. Very helpful, and that was a good line about the greatest force being inertia. If I can ask one follow-up questions, given all of that, given that private capital is there and ready to be deployed, and given the gap and given the demand on the developing countries side, how do you direct and mobilize capital and action on the ground? What's needed to scale capital to meet that ambition that we have?
Well, I think in our view,
you might be on mute, Curtis.
Oh, sorry, am I still on mute? No, I'm not on mute. Okay. Look, you all have been discussing these examples. I think there's a couple of things. One, we need to scale these platforms and these investment funds. We need to bring in that private finance. I think it's been my experience that what happens is a financial institution goes trying to do a project in a jurisdiction, and they go and have a discussion with that jurisdiction individually instead of collectively, right? How do we bring together all of these different pieces of the puzzle to make that work? There are tons of catalytic initiatives, many of them discussed here today, that have shown incredible promise, but they have not been able to be scaled. And so how do we identify the best and help them scale? We've got to have blended finance. We have to have, the bankable projects, that technical assistance, all of those things. I think the key is it's that other old saying, which is the whole is greater than the sum of the parts. And right now we have a lot of parts. They're not all working together to scale in the way that we need. And so I know that I'm looking forward. We're going to keep working on this. GFANZ is being launched, was really launched about 6 months ago, but we're going to launch our work plan at COP. And I hope we'll be able to make an announcement there that shows the seriousness of the GFANZ members and their commitments to EMDCs, and to work with you all to make that happen. I do think this country platform idea is really important, and taking within those country platforms both an institutional approach, whether it be a green bank or other vehicles, but as well as some of these catalytic initiatives that have been discussed today, and how do we scale them? But you need one last point is, it's a real mix of, you need the local jurisdiction to want to do it. We need those on the phone to want to do it. We need the developers to want to do it. And instead of having these one-off conversations with each pieces in the value chain, we need to find a way to bring people together to really make this work. It needs to be a very concerted effort. That inertia needs to go away.
Thanks, Curtis. No, that's well taken, and that's a role that CIF has been performing for over a decade now, bringing a range of stakeholder groups together, this convening function. and I appreciate your feedback around scaling up of climate investment funds, including the climate focused ones, in order to meet that. And that's a good segue to my final speaker. We at the CIF, we have been leading the charge in terms of exploring innovative modalities and approaches to accelerate clean energy investments globally. While we have some exciting announcements forthcoming in the coming weeks, we have also worked extensively on the topic of leveraging public finance using concessional resources by deploying financial intermediation and other market-based instruments. So let me invite Mafalda Duarte, CEO of the Climate Investment Funds, to share her thoughts on the role that concession finance can play in scaling up clean energy investments using market-based instruments and approaches. Mafalda.
Thank you, Abhi. And the first thing I'm going to say is that let's try to see if we crash this line and open up the cameras, because it's really awkward to be speaking for these gray boxes. So at least some of you just open up the cameras and see, seeing faces is actually a lot nicer than just seeing these gray boxes with names. And this has been really interesting. Ethan, I haven't read the report yet, but I very much look forward to reading it. And I'm very happy that some of the panelists have gone through it and have already found it to be quite useful and timely. And now that we are heading towards COP. Let me make, and I'm going to come back to you, Ethan, because I'm actually going to ask you a question. I'm supposed to be giving concluding remarks, but I'm actually going to ask you a question at some point in my intervention. So what we are hearing here is what we all know, is that we have a crisis ahead of us, and the volume of investments that is needed is quite stark. It's really large. And it's not going to come from public sector, of course. It's going to come from the private capital. And so, and there's, as Curtis was also alluding to, quite a lot of discussions and engagements around how do we bridge this? The fact that there is capital, but the capital needs to flow into emerging markets, and it's actually not flowing into the emerging markets at the scale that is needed. So how do we actually bridge this and make this happen? As Abhi was saying, in our work at Climate Investment Funds, it has always been from the inception a key objective to mobilize private capital and test different ways of mobilizing private capital. And we have done that through a variety of approaches, and really, responding to what Ethan was saying, and it's in the report as well, which is how do we jumpstart markets in developing countries in areas where we haven't seen really investments happen. And so we have been doing that quite a lot in the energy sector, mostly in the energy sector, but also in terms of resilience and in the forestry and agricultural sectors, but most of it in the energy sector, and have done so through project finance, providing concessional capital, risk capital, patient capital to different types of structures and projects. We have done so, and now I have to be a bit more cautious with my use of financial intermediation, because you have broadened the concept, Ethan, in this report. We've been talking about financial intermediation a lot more when it comes to working with the local financial institutions, local commercial banks, local development banks, and really providing to them the technical assistance and the advisory support so that they can themselves structure offerings or credit lines to the markets in a variety of areas where that wasn't actually happening before. But we've also been supporting domestic bond markets. So when you were talking about, the aggregation, finding ways of aggregating assets and making that offer into capital markets, we have been doing that as well. But this is the real question. The real point is, okay, we have contributed to this. We have demonstrated approaches over the past several years in a variety of different emerging and developing countries. But the challenge is very large. I mean, the scale of the challenge is very large. So what should we be doing in this next phase of the climate investment funds? Where we are putting forward new investment programs in areas such as accelerating coal transition, as Amelie also mentioned in her intervention. So this now brings me back to some of your points, Ethan. So one of the things that we are very keen on is drawing from the lessons and what we have learned over the past 12, 13 years of investing in these markets and in this type of investments is what more can we do at that downstream project level to further mobilize private capital? What are the types of instruments that should be used more often than has been the case? What are the types of structures that should be used more often than has been the case, so that we can, even enhance that private sector capital mobilization that we have seen in the past? So that's certainly one way that we are looking at it. But the other way we are looking at it is, okay, what can we do as well to put out their offerings to the institutional capital? So not just at the downstream project level, but what I call upstream, at our fund level, at the level of our fund. So we are working as well and hope to be able in the next year to put out an offer of bonds on the back of one of our funds' balance sheet, and with that support higher ambition in climate investments in emerging markets. But also, we are exploring ways of having institutional capital come in and invest directly alongside the public capital in the CIFs themselves, and by doing so, deploy larger quantum of finance again to developing countries and emerging markets. And so this brings me back to my question. So then I will first ask the question to you, Ethan, and then I will conclude. Because in your in one of your slides, which I thought was very helpful, where I think it was the final thought slide, where you said, there's like these three categories: the commercial, investment banks, development, and green banks, and what they would be best placed to do. And then you had another one which was on insurance companies, sovereign wealth funds, pension funds, and then you had another one on private equity and venture capital funds. And so my question to you is, because what I am saying here is, we are actually trying to do things that you have categorized under B. So, for example, support structures to aggregate and capitalize on assets. And to some extent, we are also we have and are trying to do more, and even under C, where you say find ways to connect institutional pools of capital and projects, or even where you say increase liquidity by tapping into a larger range of instruments. So I actually see the development banks in ourselves, because our implementing entities are the development banks, playing a little bit of a role, not just under your first category, but also doing a little bit of what you're saying under B and under C. So I'd just like to get your thoughts on that.
Well, I'll be really quick and say, yes, certainly you are, and there's certainly more to be done. And this is also a particularly unique opportunity at this moment to do it, because of the volume of money that has been raised institutionally to support this has just really been almost off the chart this year. So, and frankly, one of the questions that we think about at Bloomberg-BNEF is, where's all that money going to go? There's so many funds that have been raised that, frankly, in a number of cases, truly private funds, without very clear sort of agendas in terms of how they plan to deploy it. And you can only build so many wind farms in the United States, frankly. We're not growing demand here. So the money just by default has to be made more available for developing countries. So I think I think you're exactly right. You guys are certainly positioning yourselves to take advantage of that. And I think that's a real opportunity overall. The last thing I'll also say though is I wouldn't overlook, what's in that first column, which is the technical assistance stuff, which is really important and is unfortunately often totally unscalable in the sense that individual countries and individual policymakers need to learn the lessons and hear the things that and that many people on this call know. Things as basic as like solar's cheap enough. It's the cheapest thing to do. To thinking about how to liberalize a power market so that you can allow private sector involvement when it's been entirely state-run for decades. These are not necessarily easy things to socialize for people, but they certainly will listen if you show up with money. And there's a lot of money that's ready to show up. But the dots definitely just need to get connected.
Now that's great. I mean, because you've just touched on something that we've also been conveying as a key message, and that was one of the success elements of the CIF in the past, is that we managed to work with a number of countries and help them with the enabling environment or with the policy and the regulatory dimensions of this transition. Because we had finance that they knew they were going to be tapping into, and to basically see the investments on the ground and have investments be done on the ground. So I think that's actually quite important and really something to, as you said, to scale up. I'm going to close by thanking all of the panelists. This was a very stimulating event. I encourage you to read the report. I will also do it myself. I'm just going to close and really stress one point that Curtis made, because again, it really speaks to what we have been doing at Climate Investment Funds, which is this notion of country platforms. It is been part of our DNA. We have provided the incentives and the platform for the multilateral development banks to come together with the governments and other financiers at the country level to really talk about strategic challenges and opportunities and how to deploy scarce public capital to really catalyze transformations or creation of markets. And so very much, and now we want to take it to the next level. So as we move forward now with these investment programs, our hope is very much that we take it to the next level. We learn from what has happened in the past 12 years, 13 years, and we take it to the next level, because I absolutely agree with Curtis and the other colleagues that we need to come together. We need to come together at the country level, all of the different finances, it's institutional capital, the public capital, the governments, and really bring to bear the comparative advantages and what these different institutions can bring to the table. I think this is the only way to really advance the agenda and reach the scale that is needed at the speed that is needed. So very much look forward to continuing these discussions with all of you and working with you in this, really important endeavor. And so again, thank you very much for Ethan, for all of the other calls. Amelie has already left. James, Heike, Curtis, thank you very much. And Abhishek, over to you if you want to say any final word. Thank you.
Thank you, Mafalda. Just one last thing, that we have shared the link to access the report in the chat box, so please go take a look. One thing I want to highlight is that the report is quite modular. It is 90 pages, but it is very modular. So don't go by the size. You can pick up a section that you are interested in and really dive into that. And it has plenty and tons of information, like we said. Once again, big shout out to our colleagues at BNEF for all their help. I see Ethan, Louisa, and Tony were connected, but there are others who have left and have contributed. So thank you once again. And thank you for joining us today for this launch.
Thanks a lot. Take care.